Don't sell your business or investment properties before understanding recapture. In the world of finance and taxation, the concepts of recapture and depreciation play crucial roles, especially for business owners and investors. Depreciation refers to the process of allocating the cost of a tangible asset over its useful life, allowing businesses to reduce their taxable income. On the other hand, recapture comes into play when an asset is sold for more than its depreciated value, requiring the seller to recapture some of the tax benefits previously enjoyed. This means that the IRS may tax the profit from the sale as ordinary income rather than capital gains. Understanding these terms is vital for anyone involved in asset management or investment strategies. Misunderstanding how recapture works can lead to unexpected tax liabilities, impacting your overall financial health. By grasping these concepts, you can make informed decisions that optimize your tax situation and enhance your investment returns. In this discussion, we'll delve deeper into the nuances of recapture and depreciation, breaking down complex ideas into digestible insights. So whether you're a seasoned investor or just starting out, stick around as we explore how these financial principles can affect your bottom line. Depreciation is an accounting method used to allocate the cost of a tangible asset over its useful life. The primary purpose of depreciation is to match the expense of an asset with the revenue it generates, providing a more accurate picture of a company's financial health. By recognizing depreciation, businesses can reduce their taxable income, reflecting the wear and tear on their assets over time. There are several methods for calculating depreciation, each with its own implications. The most common methods include straight-line depreciation, which spreads the cost evenly over the asset's life, and declining balance depreciation, which accelerates the expense in the earlier years. Other methods, like units of production, tie depreciation to the asset's usage, making it ideal for machinery that may have variable output. Assets that typically depreciate include vehicles, machinery, office equipment, and buildings. For instance, a delivery truck purchased for a business will lose value over time due to mileage and wear, impacting its resale value. Understanding depreciation is essential for effective asset management and financial planning, ensuring that businesses can accurately report their financial status and make informed investment decisions. Recapture refers to the process by which the IRS reclaims tax benefits previously granted to a taxpayer when a depreciated asset is sold for more than its adjusted basis. In simpler terms, when you sell an asset that has been depreciated, any gain realized on the sale may be subject to recapture, meaning you could owe taxes on the amount of depreciation you claimed. This is particularly relevant in the context of real estate and other capital assets. When a property owner sells a rental property that has been depreciated, the IRS requires them to recapture the depreciation taken during the ownership period. For example, if you purchased a rental property for $300,000 and claimed $50,000 in depreciation over the years, and then sold it for $400,000, the $50,000 in depreciation would be taxed as ordinary income rather than at the lower capital gains rate. Recapture can also apply to other assets, such as machinery or vehicles. Understanding recapture is crucial for investors and business owners, as it can significantly impact the overall tax liability upon the sale of an asset, influencing financial planning and investment strategies. Calculating recapture tax involves a straightforward formula that helps determine the amount of tax owed when a depreciated asset is sold. The basic formula for calculating recapture tax is recapture tax, whence selling price, adjusted basis, x depreciation rate. To break this down, the adjusted basis is the original purchase price minus any depreciation claimed. The selling price is the amount received from the sale of the asset. It's essential to maintain accurate records of both the purchase price and the depreciation taken over the years to ensure precise calculations. For example, let's say you bought a piece of machinery for $100,000 and claim $30,000 in depreciation over its useful life. If you sell the machinery for $80,000, your adjusted basis would be $70,000, $100,000, $30,000. The gain from the sale would be $10,000, $80,000, $70,000. If the depreciation rate is 25%, your recapture tax would be $2 out of $500, $10,000 x 25%. Accurate record keeping is crucial in this process, as it ensures you have the necessary documentation to support your calculations and comply with tax regulations, ultimately avoiding potential penalties. The tax rates applicable to recapture can vary. For most assets, the recaptured amount is taxed at your ordinary income tax rate, which can be as high as 37% for high-income earners. However, for real estate, the recapture tax rate on depreciation is capped at 25%, providing some relief compared to ordinary income rates. For example, consider a commercial property purchased for $500,000 with $100,000 in depreciation claimed over the years. If sold for $700,000, the gain of $300,000 would include $100,000 subject to recapture. The recapture portion would be taxed at 25%, while the remaining gain would be taxed at the applicable capital gains rate. Understanding these implications is crucial for effective tax planning and maximizing returns on asset sales. Minimizing recapture tax liabilities is essential for maximizing your financial returns when selling depreciated assets. One effective strategy is to carefully consider the timing of asset sales. Holding on to an asset until it has fully depreciated can reduce the recapture impact, as the adjusted basis will be lower, potentially resulting in less taxable gain. Additionally, selling during a year when your income is lower may help you benefit from a lower tax bracket. Another powerful option is to utilize like-kind exchanges, also known as 1031 exchanges. This strategy allows you to defer paying taxes on the gain from the sale of an asset by reinvesting the proceeds into a similar asset. By doing so, you can postpone recapture tax liabilities, allowing your investments to grow without immediate tax consequences. You can check out our earlier video dispelling the myths of 1031 tax exchanges. Lastly, maintaining accurate depreciation records is crucial. Keeping detailed documentation of all depreciation claimed on your assets ensures you can accurately calculate your adjusted basis when it's time to sell. This not only helps in minimizing recapture, but also protects you in case of an audit. By implementing these strategies, you can effectively manage and reduce your recapture tax liabilities, enhancing your overall investment strategy. In summary, understanding recapture and depreciation is vital for effective financial planning and asset management. We've explored how depreciation allows businesses to allocate the cost of tangible assets over time, reducing taxable income. However, when these assets are sold, recapture comes into play, potentially increasing your tax liability by taxing previously claimed depreciation as ordinary income. Recognizing the implications of recapture is essential for making informed decisions about asset sales, as it can significantly impact your overall financial health. By applying the strategies discussed, such as timing your sales, considering like-kind exchanges, and maintaining accurate depreciation records, you can effectively manage and minimize your recapture tax liabilities. We encourage you to take this knowledge and apply it to your own financial situations, ensuring you're well prepared for any asset transactions. If you found this information helpful, please subscribe to our channel, like this video, and share it with others who may benefit from understanding these important financial concepts. Stay tuned for more engaging content that will empower you to make smarter financial decisions.